The market's collapsing. Headlines scream about the end of the world. You're watching your savings disappear before your eyes, and everyone's telling you to sell, sell, sell. But hold on. Before you make the biggest mistake of your financial life, listen to me. My name's Nolan Matthias, and I've spent the last 20 years helping people like you navigate financial storms. I've seen the panic, the fear, and the desperation, and I'm here to tell you that this is not the time to give in. Most people make the same mistakes over and over again. They panic sell at the bottom, locking in losses. They chase the next hot stock only to get burned. They listen to the noise, not the facts. Today, I'm going to show you a better way. A way to not just survive market crashes, but to thrive. And the way you're going to do this is by understanding that when markets are crashing, this is the number one mistake you need to avoid. But in order to understand the mistakes you need to avoid, you need to understand the historical examples. We need to learn from the past. And the good news is we don't need to go very far back in history to learn everything we need to know about how to survive and thrive during a market crash. So let's start by looking at the dot-com bubble. This is where the NASDAQ fell 78% from its peak. It was a time where pretty much any company that had .com at the end of it was worth billions. But most of these companies were speculative in nature, and they disappeared pretty much overnight. But interestingly enough, some companies actually thrived during this time. Amazon, for example, fell to $6, but it was able to recover to the equivalent of $3,000 today. And if there's a lesson from the dot-com bubble, it's to always understand exactly what you're investing in. Avoid unproven investments and stick to quality. Because of all the dot-com era companies, Amazon, it turns out, was the only one that really had a great business model. And if the investors of 1998 and 1999 had only been looking for quality, they would have survived. And not only would they have survived, they probably would have thrived. Then fast forward to 2008, the S&P 500 dropped 50% plus. People actually thought the financial system was coming to an end. And the panic wasn't just in the US, but it was global. But by 2013, the stock market and the economy had essentially recovered fully. But those who sold in 2008 and 2009, they missed up to 400% in gains. They essentially locked in their losses. And the irony is, a lot of the people who sold didn't actually need to sell. They didn't need the money. But the fear driven by that 50% drop pretty much overnight in their net worth led them to lock in the losses and almost guarantee the fact that they would never recover. Then just 12 years later, there was the COVID crash, 30% drop. And those people that made the same mistake as those in 2008 who sold everything missed out on the fastest recovery in history. Those who panic sold missed out on almost 100% recovery in a very short period of time. Because the mistake they made was thinking that if they sold, they'd be able to time the market, get back in, and miss out on even greater losses. Because the people who sold when the stock market dropped by 30% almost certainly thought it was going to drop more. And they proved one of the most important realities of investing. It's that you can't time the markets. But the question is, why do people panic sell? Because it causes a significant amount of damage. And the answer is fear. When people see their net worth decline by 30 or 50% overnight, they get scared. But if you can retrain your brain to understand that a crisis is actually opportunity, you can position yourself so that you can take advantage of those drops rather than locking in your losses. So let's talk about the psychology of panic selling. Obviously, fear drives irrational decisions. For most people, the single best thing that they can do is take any sort of emotion out of investing by having a strategy that they stick to no matter what. Because when the media headlines start to say everything's going to collapse, that's when people panic. And setting up your finances in such a way that you don't panic is the key to making sure that when the market falls, you're in a position to take advantage of it rather than lock in your losses. And it's that structure and that system that allows you to avoid the this time is different mentality that so many people fall victim to. Because guess what? The market does in fact always recover. Sometimes quickly, sometimes over a long period of time. But the only people that lose are the people that sell and lock in losses. They're the people that make the two most deadly mistakes when it comes to investing. The first is selling low during crashes, selling the things that go down in value that are valued way less than what they should be, and then taking that money and putting it into overvalued safe havens like gold, which are overpriced and inevitably are going to go down in value. In fact, it's the exact opposite thing that should be happening. The things that are maintaining their value or going up in price are the things you should be selling and taking that money and converting it into the things that are on sale. But people for some reason think that they can time the market. And timing the market never works. In fact, selling at the lows and missing the 10 best trading days can cut returns in half, which is why the best investors in the world always stay in the market even if the market is going down. They might limit their exposure by not having as much money in the market, but they're always in the market. And the reason they're always in the market is because they know that nobody can consistently predict market bottoms or tops. They know that even though they are professional traders, they can't do it reliably. But there are people out there who've created strategies so that they are always positioned to take advantage of market downturns, while at the same time not suffering significant losses when the market does crash. One such individual is Ray Dalio, who created the all-weather portfolio, which, for most people it seems, could be the ultimate solution to not losing at all and panic selling when the market has a downturn. So what's the all-weather portfolio? Well, it's the type of portfolio that is designed to essentially set it and forget it. It performs well in pretty much every economic environment, and it's based on the economic seasons concept. Just like when it comes to the weather, there are seasons, and in the same way, there are economic seasons as well. And Ray Dalio was able to, in a very genius way, build his portfolio out so that no matter whether it was spring, winter, summer, or fall, the all-weather portfolio performs well. And here's how this all breaks down. So a lot of people will put all of their money into one type of investments: GICs, stocks, Bitcoin, gold. And that's the worst thing you can do. You need to have a portfolio that's diversified not for the types of investments or the number of investments, but for risk. And in order to do that, Dalio suggests that you put 30% of your money into stocks, 40% into long-term bonds, 15% into intermediate bonds, 7.5% into gold, and 7.5% into commodities. And by doing this, you position yourself in such a way that no matter what the market is doing, you have certain investments that are going up in value, certain investments that are going down, and most importantly, when there is a major crash in the stock market, the drawdowns, or in other words, the amount that your investments drop in value, is minimized. Because in times of growth, the stocks perform well. In recessions, the bonds perform well. When there's inflation, gold and commodities do really well. And when there's deflation, long-term bonds perform well. So regardless of what's going on in the economy, you've always got a certain percentage of your investments that are going to perform and make up for the losses of the others. And if you're consistently rebalancing, so in other words, making sure that your investments are always in line with the suggested allocations, well, then what you're doing is you're always selling investments that are priced high in order to buy investments that are priced low. And what ends up happening is something like this. In 2008, even though the stock market crashed by 50%, there was limited downside in the all-weather portfolio. In 2020, people who had an all-weather style portfolio were able to have pretty stable investments. And as a result, the returns over time, historically, going back 50 years, have been pretty consistent with what just investing in the S&P 500 would have gained, but with significantly lower volatility. So in 2008, when stocks dropped by 50%, if you had been all in on the S&P 500, your net worth would have gone down probably by about 50%. But with an all-weather portfolio, your net worth would have only gone down by 3 to 10%, which means you don't need to have as much fear when the stock market crashes because the structure of your portfolio is set up in such a way that the damage is going to be minimized. And this is what removes the emotional decision-making. And as long as you do the following, you regularly rebalance, either monthly or quarterly or annually, you stick to the percentages, and you don't try to time the shifts in the market, you'll do fairly well. And you can set this whole thing up using low-cost ETF. Just talk to your financial advisor about what low-cost ETFs to use, or go out and Google it. But make sure that where you're getting the advice from is a place that has your best interests at heart. And once you have this set up, make sure you always keep the following in mind. Panic selling is the #1 wealth destroyer. Market timing never works. Quality investments always recover. And having a portfolio that's set up to remove emotion is the single best thing that you can do in order to protect your finances. Well, at least the single best thing you can do other than avoiding debt. Oh, and by the way, if you want to know what always happens right before a market crash, make sure you check out this video right here.